I think this kind of 2000 bubble that we have is dangerously likely to morph into the 1970s.
Okay, I know, I might have overdone it with the title on this one, but highly respected investor Jeremy Grantham recently posted a press release with his latest theory on the stock market. And those who know me know that even though I'm a long-term value investor who couldn't give a single fuck about what the stock market does in the short term, I do love a juicy economic prediction, and Grantham believes we've now entered the fourth and final stage of the super bubble. And if that doesn't have you on the edge of your seat, I don't know what will. So in today's video, I'm going to be breaking down the press release where he backs up his theory with quite a bit of data. And as always, if you enjoyed today's video, I'd appreciate it if you could take the 2 seconds to leave a like on the video and hit subscribe if you want to stay up to date with content that I post in the future. But with that said, let's jump into it. Right off the bat, the first line that Grantham says in this press release is actually really important. He says, only a few market events in an investor's career really matter. And among the most important of all are super bubbles. And yes, he is using this just simply as a segue to talk about super bubbles, but generally speaking, this is actually a really good way to think about your investments in the stock market. There actually are very few moments where you'll make key decisions, particularly if you're a long-term value investor, that make the biggest difference in your portfolio's performance over time. Real investing, where you're thinking about putting your money to work in real businesses, the ownership of real businesses, is really a game of patience. Most of the time, markets are just being markets, and there will be good periods, there'll be bad periods. Most of the time, you're just kind of riding the waves of the stock market and of the economy. And then in very rare moments, there will be the opportunity to get into an amazing company when there is a massive amount of pessimism around it. And in what we're going to talk about today in super bubbles, this is an opportunity where broadly there will be opportunity to get into great companies at lower prices. But generally speaking, there are just very few moments across your career or across your investing lifetime where you'll make big decisions that make the most impact in your portfolio. Grantham in the press release talks about his theory of bubbles in general. He says, most of the time, 85% or thereabouts, markets behave quite normally. In these periods, investors, managers, clients, and individuals are happy enough. But alas, these periods truly do not matter. It is only the other 15% of the time that matters, when investors get carried away and become irrational. These irrational periods we call bubbles. This is essentially where investors are euphoric about the recent performance of investments, and as a result, they incorrectly extrapolate the recent good performance into the future and expect that what has happened recently will continue to happen for many years, essentially meaning people begin to speculate on what stock prices will do rather than truly assessing the value of the cash flows that the business is likely to produce in the future. And Grantham believes that there are two types of bubbles. There are just regular bubbles, which he actually fits into the 85% of the time markets behave normally. That's kind of just the normal ups and downs of the stock market that happens over 8 to 10 year periods or 5 to 8 year periods. And then about 15% of the time, there are these super bubble periods. He says mostly about 12% of the time, this irrationality is excess optimism. When you see meme stock squeezes and IPO frenzies, such as the last 2 years, and just now and then, about 3% of the time, investors panic and sell regardless of value, as they did at 666 on the S&P in 2009, and with many stocks trading at 2.5 times earnings in 1974. These times of euphoria and panic are the most important for portfolios and the most dangerous for careers. And that last line couldn't be more true. These are the periods where you see who are the fools and who are the real investors. The fools in the market will be wrapped up in the super bubble. They'll be speculating, enjoying the gains of the recent past, even though they don't actually understand the businesses they're investing in. And they'll be piling into businesses that they don't really understand, speculating on prices going higher, while real investors are waiting patiently for the prices of businesses to fall far below the value of those businesses. And Grantham says that this happens about 3% of the time. Most of the time during a super bubble, it's euphoria, and then there's a sharp, short period where investors are panicking and selling everything regardless of value. And that's where a patient, disciplined investor can get into great businesses at low prices. And I tell you what, if you just look at the YouTube space, we are absolutely seeing this divergence, and we have seen this divergence over the past couple of years. I'm not going to name anyone specifically, but there are big creators on the platform who have been pushing a number of speculative stocks over the past couple of years, and they're now scrambling to hide the fact that their top 1, 2, 3, 4 investments over the past couple of years are all down 60, 70, 80, maybe even 90%. Grantham goes on to talk about how the US has actually experienced 3 of these bubbles previously, these super bubbles, and that he believes we are now in another one. Outcomes for this unique group of super bubbles, just 3 in modern times in the US before the current one, are indeed special. The much discussed by us divergence between conservative and speculative stocks, the rapid bear market rallies discussed later here, the rapid onset of recession, 3 out of 3 incidents to date, with 1 mild in 2000 and the other 2 in 1929 and 1972, which were severe. And finally, the much increased probability of further unexpected financial and economic accidents. So what are the stages of the super bubbles? What can we look back at over these 3 previous super bubbles and look for patterns in what we're seeing in the markets today? The first stage, the bubble forms. Second, a setback occurs, just as it did in the first half of this year, when some wrinkles in the economic or political environment cause investors to realize that perfection, after all, will not last forever, and valuations take a half step back. Then there is what we have just seen, the bear market rally. Fourth and finally, fundamentals deteriorate and the market declines to a low. Grantham believes we're in this third stage of the super bubble where markets recover about 50% of the losses that have happened over the past year, and this is something that has been a feature of the previous 3 bubbles. From the November low in 1929 to April 1930 high, the market rallied 46%, which was a 55% recovery of the losses from the peak. In 1973, the summer rally after the initial decline recovered 59% of the S&P 500's total loss from high. In 2000, the Nasdaq, which has been the main event of the tech bubble, recovered 60% in its initial loss just after 2 months. And in 2022, this year, at the intraday peak on August 16th, the S&P 500 had made back 58% of its losses since its June low. Thus, we could say the current event so far looks eerily similar to the other historical bubbles. Grantham goes on to explain what we should expect to see in the next stage, going on from this point forward. The next leg for the model is likely to be driven by falling margins. Our best guess is that the level of explained price to earnings ratio will fall towards 15 compared to the current level of explained price to earnings ratio of just under 20, while the actual PE just rose from 30 to 34 times in mid-August, which was probably a bear market rally. Here, Grantham is talking about the multiple that investors are willing to pay in terms of stock prices on their current earnings. He believes that this should be approaching 15 times earnings, whereas it's currently at about over 30 times earnings, which would mean even if earnings stayed flat, if the price to earnings ratio contracted that much, it would cause a more than 50% decline in the stock market. And this actually isn't a completely unbacked, unreasonable position to take. And the one way we can think about it is in relation to interest rates. With inflation not slowing down in the US, the Federal Reserve is likely to continue to raise interest rates, at least for the foreseeable future. And as that happens, that puts downward pressure on stock prices. And that's simply because as interest rates go up, the return that you can get on government bonds and on corporate bonds and other risky assets also goes up, and that makes them relatively more attractive compared to stocks. In fact, if you exclude economic growth, then the changes in interest rates are actually the biggest factor influencing stock prices and their valuations. The federal funds rate, the official interest rate in the US, has averaged about 5.4% since 1971. So as interest rates approach that, you would expect that the market PE would probably approach the average market PE, which has been around 15. So in simple terms, if inflation continues and the Fed has to continue to raise interest rates maybe another 3 or 4 different times over the next 12 months maybe, or over the next 6 months, then it wouldn't be unreasonable to expect that the market would approach 15 times earnings, which is what Grantham expects to happen. So then why am I personally not selling my shares? Why am I not looking at this press release and thinking, crap, I should be out of the market, it's going to fall another 50%? It's simply because I think that some of the inputs that Grantham is using to predict what the market will do in the short term are unpredictable things. For example, take his core assumption that profit margins will fall over the next 6 to 12 months. Given that we're in a high inflation environment, that's a fairly reasonable prediction to make. But what's to say that inflation doesn't slow down from here? What's to say that there aren't a number of global catalysts that improve economic conditions and actually mean that the Federal Reserve doesn't need to do a number of rate hikes? In fact, maybe they may be lowering interest rates in 12 months' time. That's not my prediction. I don't know what's going to happen, but things broadly can change very, very quickly. Think about how quickly inflation surged in the US. It's only really just happened in the past 12 to 18 months. It's been a very fast transition. Things can change very, very quickly, and from what I've seen over the past few years, it's very, very difficult to predict what is going to happen with inflation or interest rates. So using them to make predictions about what the stock market will do tends to lead to making decisions about your portfolio that don't really make any sense when you can just think of your investments as if you're a business owner. Because of the types of businesses that I hold in my portfolio, it doesn't really matter in the short term what stock prices do. They have enough cash to fund their operations to last through a period of weak economic activity. And out the other side, they have massive growth opportunities. So I have no problem kind of riding the wave of what happens. And if stock prices come down, it's just an opportunity for me to add more to those investments.